Welcome back to Trading with CJ. Now, if you watched one of my previous videos on the top 3 stocks I own, you will know that my number 1 stock is Disney. So I thought it's about time that we covered Disney on this channel. Now, I mentioned in that previous video that I may lose a follower or two here, but I'm not particularly a fan of the Disney films. However, Disney are so much more than that. They have built so many different revenue streams that it is very hard to ignore this global company. They have been very good to me. I have taken profits from Disney, but I'm still very much invested. But does that necessarily mean I'll be buying more? Well, let's take a deeper dive into Disney and see if at these current prices they are still a buy. Now, before we get into this, I want to say that I am not a financial advisor, so if you are planning on investing into the stock market, you should always do your own research first. And as usual, if you can hit the like and subscribe to my channel, that is very much appreciated. So let's get into it. So as I said, Disney have multiple revenue streams and they also have large stakes in lots of other companies. Now, I'm actually going to put a picture up here, and this is a post that was on my Instagram page. So if you want to check that out as well, it's @TradingCJ. You can see a list of lots of different companies here. Aside from this, they also have their theme parks, their cruise lines, their movies. They have ESPN with the sports, their online streaming service, Disney Plus. They have literally got it all. So with that being said, it is no surprise that Disney's share price took a massive hit back in February and March thanks to the global situation. Pretty much all of their revenue streams, except for the Disney Plus, grinded to a halt. Movie theatres were closed, theme parks were closed, etc. However, over the past few weeks, things have started to reopen again and the share price was on its way back up. So now let's take a look at some of its financials and see how they're coming along. So the market cap for Disney currently sits at $222.4 billion. It is one of the biggest companies in the world, and like I said before, pretty much every single person has heard of Walt Disney. Disney is currently trading at $125 at the time of recording this, and that has recovered substantially since the crash when it went down to lows of $85. So if you did buy in at those lows, you are seeing a huge upside right now. Like I say, it's currently $125. Now this is slightly less than it was pre-crash back in February 20th when it was at $140. So it's still a little bit off of that, but it's not far away now. And in its highs in the last 52 weeks was $151. So it has recovered quite nicely. This is its 1-year graph here. And if we go into its we get maximum here, this takes us all the way back to 1990. So you can see it just kind of remained flat, and then the growth really did start to take off around about 2009, and we just kept seeing continuous growth from Disney, now becoming one of the largest companies with a huge market cap. And at this current price, Disney is, according to analysts, overvalued by 27%. Its fair value is about $98, and it's currently overvalued according to analysts. But Disney is one of the biggest growth companies out there. It's more of a stable company. It's not very volatile in terms of its price. It doesn't fluctuate that much, and it has had consistent growth over time. Like I said, they have all these different revenue streams, so they've got their fingers in a lot of different pies. So okay, it might be overvalued according to analysts here based on their current revenue and earnings, etc. However, this is a company that you're invested into due to it being a consistent performer and its stability. So at its current price, it is predicted to be overvalued there. Now, there is no PE ratio for Disney because at this moment in time, they are unprofitable. They was profitable pre-crash before everything's gone on in the world, but at the moment they are slightly negative, so there is no PE ratio at this moment in time. However, the future growth is looking promising. From analysts, in the next 1 to 3 years, it is predicted to be 50.6%, which is a huge annual earnings growth. And looking at these forecasts here, we can see we're currently around about here, 2020, where we've just gone into negative earnings. One of the lowest it's been for quite a while, negative 3.61 billion. However, if we go back to a year's time, September 2021, it is predicted to be plus and back to 3.34 billion in earnings. And you can see this just prediction keeps getting higher and higher. Eventually, come 2025, 14.16 billion in earnings and 106.277 billion in revenue. And if we compare these future growth forecasts, we can see here Disney sits at 50.6%. in terms of the next 1 to 3 years, compared to the market, which is predicted, this is obviously USA, 22.4%. So they are doubling that of the market in the next 1 to 3 years. Which brings us on to the future return on equity. In the next 3 years, it's predicted to be 11.4%, which is slightly less than industry, which you can see there of 16.8%. But nevertheless, it is positive, and that's a fairly okay future return. This is not one of the biggest growth companies out there. Like I say, it's a stable growth, just consistently, slowly over time going up. However, 11.4% future return on equity, that's quite good growth for a company of this stature. So how are their earnings and revenue performing? Well, if we look here at their profit. So they was doing pretty decent, pretty consistent there, roughly constantly at about 16% profit margin. And then we went up to about 19, 20% around about 2019. Pre-crash level, they was trading at 13% profit margin. And that is slowly, as you can see, dropped off down to 6.2. And now, as of June 27th, this is at negative. So they're making a loss now of 1.9% profit margin. That's minus 1.32 billion. So that is to be expected with everything that's going on. If we go on to some news surrounding Disney here, actually, we can see that recently, this came out just a few weeks ago, Disney have cut 28,000 jobs. This is mainly part-time jobs within their company. It's about 67% of that is part-time workers. So whilst that's not good to see, we don't want people to be losing their jobs, etc. They're doing what they can to try and protect their profits. And we know that some of their Disney World parks open in Hong Kong, they had to close again due to COVID, and then once again it's now reopening again. So they are doing what they can to try and protect. You can see here 67% were part-time, so they're trying to protect some of that money, some of that income. You know, things aren't completely open. There's no point paying out every single person, and when they're losing money at the moment. And this is massive here. We can see, look, experiences and products division plummeted 85% compared to where they was in the previous quarter in 2019. 85%. And we do know that their theme parks bring in a massive amount of Disney's revenue. And let's just have a look at their balance sheet here. We can see that a financial position, they've got 41 billion in short-term assets and 166 billion in long-term assets. The short-term outweigh the short-term liabilities and the long-term outweigh the long-term liabilities. So this is pretty good going, to be fair. They have a lot of assets, all of the theme parks they own, all the cruise lines, etc. They have a lot of different revenue streams. So assets not to worry about. They're 166.32 billion in assets. So the main thing we can see here is obviously the debt, which is in the red, the 64.4 billion. That sounds like a huge amount, and it is quite high, but we are talking about a company here with a current market cap of 222 billion and about 166 in long-term assets. So there's 64 billion in debt, but they do have 23 billion in cash. So, okay, they're definitely debt heavy when it comes to cash, but there is 23 billion sitting on the balance sheet at this moment in time. So it would be nice to have that debt reduced. Once things start opening up again, they can start to pay off that debt. Like I say, things are opening up, but it's a very slow progress. You know, films are still taking a long time to come out. The Disney Plus streaming service is still relatively new in the grand scheme of things. Theme parks can't operate exactly how they was beforehand. Plus, you know, they're losing a lot of people who are willing to go right now, not to mention the cruise lines. Cruises still aren't really operating at anywhere near the capacity they was. So there's still a lot of upside for this. Of course, there is still an element of risk in case things don't get back to how they was. But I do think, you know, Disney is a company with a huge innovation. They can constantly come up with new ideas and, you know, work their way around this. So if we look at their debt to equity, we can see that they currently have 64.7% debt. So that has increased, bearing in mind before the crash, which was, where are we at? Here, around about here, it was 53.3%. So it has gone up slightly, but in the grand scheme of things, that's not too bad. It was 53.3, and now they have 64.7. So it's one of their closest debt to equity ratios that they have had all the way back here. Takes us back to 2013. It was around about 32% back then. So they have taken on a lot more debt since then, but 64.7% is not the end of the world. And that's a debt to equity there of 64 billion to 99 in equity. However, they do now have more cash. They now have 23.11 billion in cash, as opposed to when it was in December last year when they had 6 billion. So onto their dividend, they're not paying a dividend at the moment, but it is forecasted to be paying a 1.18%. They obviously was paying a dividend, it got cut to save money, which is probably a good move from Disney. And now it's currently projected to be paying out 1.18% forecasted dividend yield. But speaking of this, there was talks recently, lots of news around Disney, that the future dividend won't be going ahead and it will be getting cut, which obviously as an investor, you want to be getting some extra money, some dividends. But if it means, they can reinvest that money back into the company, they want to put it into their online streaming service, improve that platform, then maybe it's a right decision for the time being anyway. But if we do look at the dividend growth payments here, we can see that it was paying out around about $1.70 per share, which is pretty good. Does a dividend yield of 1.5%. It was growing and growing, and then obviously that got cut, so we're currently at 0. And like I say, it is predicted to be going back up according to analysts, but there is a lot of news out recently that it may not be after all. So whilst they may have suffered a setback, I do think that Disney will be around for a very long time and continue to grow. I don't think we've seen the end of Mickey Mouse and his friends anytime soon. So with that being said, I'm already quite heavy in Disney. It is my largest holding, so I won't be adding any more at its current prices. I don't want my portfolio to become too unbalanced. And whilst it is one of my favourite companies, I do think there are a lot of other companies out there with huge growth potential, albeit maybe slightly riskier, whereas Disney, whilst it does have the growth, it could be considered more of a safer play. So I'd be interested to know your thoughts on Disney. Is this a company that you hold or maybe you're considering buying into? Let me know down in the comments below. And if you've enjoyed this video or you just want to help me out, please hit the like and subscribe to my channel. It really is appreciated. Thanks for watching, and until next time,